When we talk about the Great Crash of 1929, Black Tuesday, it's usually presented as this financial tsunami, a colossal, unforgiving event that just struck without warning, wiped out decades of wealth in, a matter of days. It's treated in the history books almost like an earthquake.
And that framing is really comforting, isn't it? Because if it was an unpredictable earthquake, then, well, nobody could have possibly seen it coming.
Right, nobody's at fault.
Exactly, and nobody is truly responsible. It lets us view the victims as just unfortunate, not as people who were fundamentally mistaken in their strategy.
But our investigation today, and we're pulling from a number of fascinating sources here, it suggests something far more intriguing and, frankly, far more terrifying.
Which is?
What if that catastrophe wasn't a random disaster at all? What if it was a meticulously followed script? And what if the lead actor in that script, the man who would become the architect of one of America's greatest political dynasties, didn't just survive the crash?
He profited from it.
Yeah.
Monumentally.
He executed a precise mechanical blueprint to profit from it.
We are, of course, talking about Joseph P. Kennedy, JFK's father, the ultimate financial pragmatist. And the shocking detail, the one that always gets me, is that he sold his entire portfolio exactly 47 days before the peak panic in October 1929.
47 days.
And this was not luck. I mean, let's be very clear. It wasn't even based on some secret inside information. It was based on a cold, objective assessment of market psychology and, crucially, the mathematics of leverage.
So today we are opening the forensic file on what we're calling the Kennedy strategy. Our mission is to treat this historical event not as some dusty curiosity, but as an actionable blueprint for financial survival and maybe even wealth creation in 2026.
And this strategy, it demands a level of calculated ruthlessness and, maybe more importantly, a complete willingness to stand alone.
That's the key. Because what Kennedy did was he chose to stop being a potential victim of the market and become an unapologetic financial predator. The tone here is so essential. This isn't about, gentle diversification or prudent portfolio rebalancing.
No.
It's about leveraging systemic collapse into generational wealth. And the architecture of it is surprisingly simple. It's built on 3 core deconstructible pillars.
Okay, let's lay them out.
First, the psychological signal that single moment, market saturation has been hit. Second, the mechanical leverage trap that guarantees the collapse will be swift and brutal. And third, the ruthless 3-phase playbook: exit, hedge, and reentry.
We're going to show you exactly what that signal looked like in 1929, how it's manifesting in our highly leveraged world today, and why executing this strategy requires you to be willing to be lonely to be rich.
That's it.
It means taking your chips off the table when the fear of missing out FOMO is at its absolute peak, and when your friends, the media, everyone is calling you a fool for doing it. Let's unpack this forensic evidence. So the entry point into the Kennedy strategy, it isn't some complex economic indicator or, a Fed meeting transcript.
Thought it all.
It's a simple human interaction that provides just devastating psychological clarity. We have to start with the legend of the Shoeshine Boy.
It's the foundational anecdote of market psychology, really. But its profound meaning often gets lost in the retelling.
People think it's just a cute story.
Right. So Kennedy was, according to the story, on his way to work in the financial district. He stops for a shoe shine, and the young man, cleaning his shoes, leans up and offers him a stock tip.
And the specifics change depending on who's telling it, right?
They do. Maybe it was Hindenburg Oil or some other speculative darling of the day. But the substance is that the boy was enthusiastically urging this wealthy man to buy a stock because, quote, it was going to the moon.
And Kennedy's reaction is the entire lesson here. He didn't dismiss the boy because the stock was bad. He dismissed the entire market because the messenger was wrong.
Exactly. That moment, as simple as it seems, it crystallized the mechanism of every great speculative bubble. And that mechanism is the greater fool theory.
Okay, let's break that down for a moment because it's so important.
The theory basically explains that assets can achieve these completely irrational valuations because investors aren't buying based on underlying value, earnings, cash flow, intrinsic worth, none of that.
They're just buying it to flip it.
They're buying purely on the belief that they can successfully sell that asset to a greater fool tomorrow for a slightly higher price. And as long as there is an endless supply of greater fools, the bubble just keeps inflating.
So if the market's entire valuation is just resting on this assumption of finding the next buyer, the key question becomes,
who is left to buy?
Who is left to buy? And that's what the Shoeshine Boy represented.
Precisely. In the economic hierarchy of 1929, the Shoeshine Boy was at the literal base of the pyramid. He had the lowest reserves of capital, the least amount of investment knowledge, and was usually the absolute last person to get reliable information.
So when that individual, the person with the least financial risk tolerance and the smallest war chest, is not only in the market, but is so confident that he's giving aggressive, speculative advice.
It means the market has fully saturated. The speculative mania has reached the last possible buyer.
The confidence is the key there, isn't it?
Yeah.
It's not just that he was investing. It's that he was so enthusiastic he was advising others.
That's the signal. It means speculative euphoria has hit 100% participation. And when that happens, the mathematical structure of the greater fool theory just collapses.
There's nobody left.
There is literally nobody left on the sidelines with fresh capital or, the belief in a quick profit ready to bid prices higher. Kennedy's reaction was an immediate mechanical realization. The buying power is exhausted, the market top is in.
And if the buying stops,
If the pool of fools runs dry, the only possible move for prices is down, often violently. And Kennedy acted on that realization with absolute solitude, selling everything over the next 47 days.
which brings us to the modern signal flash. I mean, we can't just look for literal shoeshine boys today. The economy is structured completely differently. But that core psychological principle, the reaching of speculative mania into the furthest, least capitalized corners of the market, that remains the blueprint. According to the sources we're looking at, that signal is flashing blood red in 2026.
We have to translate the 1929 dynamic into the 21st century's digital landscape. But the characteristics of the messenger, they remain the same. High enthusiasm, low historical capital base, sophisticated jargon used very casually, and participation in highly volatile instruments.
Okay, let's get specific. The first example from the source. Your Uber driver asking about the Fed pivot.
Right.
Think about that. Think about the sheer volume of nuanced macroeconomic jargon that has seeped into service-level casual conversation. I mean, 5 years ago, discussing the details of the Federal Reserve's quantitative tightening policy, that was for PhD economists.
Or hedge fund managers, maybe.
Right. Now it's background noise on a trip to the airport. When these extremely complex abstract concepts become common parlance, it shows that pure speculation is driving the conversation, not fundamental analysis.
Or consider the complexity of the instruments being discussed. The source points out your dentist giving tips on a short squeeze.
Yeah, that's a huge red flag.
It's a massive indicator. A short squeeze is a complicated, high-risk market event. It's often associated with, that highly volatile meme stock behavior. It implies that professionals outside of finance aren't just buying blue-chip index funds.
They're day trading.
They are actively immersed in these volatile, nuanced, zero-sum trading strategies, driven entirely by excitement and herd momentum, not intrinsic value.
But maybe the most aggressive, the clearest indicator of saturation today is the explosion of hyper-leveraged retail trading. I'm talking about teenagers trading zero DTE options, 0 days to expiration options on their phones during their lunch breaks.
We need to go into detail on why this specific product signifies the end game.
Please do.
Zero DTE options are, for all intents and purposes, pure lottery tickets. They are highly complex financial instruments designed to expire, usually within the same day they are purchased.
So they're not investments.
Not even close. They offer massive leverage with minimal capital. You can control hundreds of thousands of dollars worth of stock movement for maybe a few $100s. But, and this is the key, if the stock moves even slightly against your prediction, the option instantly becomes worthless. Zero.
So there are high-stakes, high-velocity gambles. Why does their popularity scream saturation?
Because of the low barrier to entry and that lottery mentality,
Yeah.
the platforms make it easy, the potential reward is intoxicating. And when this level of hyper-speculation, where the, quote, investor is accepting the near certainty of total capital loss for a tiny chance at an astronomical gain, reaches the pockets of the least capitalized individuals,
The teenagers at lunch.
we have reached maximum psychological euphoria. It's the highest expression of the greater fool theory. People are gambling their lunch money not on analysis, but on the hope of instantaneous, leveraged wealth. The system is consuming itself from the bottom up.
This brings us right back to the cost of solitude. Kennedy sold everything based on a signal that everyone else was ignoring. He had to endure 47 days of watching the market continue to creep up, knowing he was missing those final gains.
The last 10%.
And looking back, we know his friends who stayed in lost everything. But at that moment, in real time, he looked like an idiot.
And that willingness to accept temporary humiliation is the core requirement of the Kennedy strategy. You have to realize that the final rally, that last intoxicating burst, is the market's trap.
It's designed to pull you in.
It is designed specifically to pull in the last remaining skeptical capital. By selling 47 days early, Kennedy paid an insurance premium. He missed that final 10% gain, but he guaranteed he would avoid the 90% wipeout that followed.
The moment you act on this saturation signal, you are choosing to be lonely.
You are. Because the consensus, the media, everyone will assure you that the new era has arrived and that markets only go up. Wealth generation during a crisis. It demands that kind of emotional isolation.
Okay, so we've established the psychological signal, the flash of red that tells you when to get out. But Kennedy wasn't just relying on market folklore. He understood the cold financial physics that dictated how the market would fall.
Yes.
So we need to shift our forensic investigation now from sentiment to mechanism, the catastrophic self-reinforcing debt trap.
And that is the essential insight. Crashes are not random collapses. They are the mechanical unwinding of excessive leverage. Kennedy didn't just see a slight decline coming. He saw a nuclear chain reaction that was already built into the very structure of the 1929 market.
So let's detail that historical structure.
Right.
The entire boom of the late 1920s was fueled by what they called broker loans, which was just the official term for margin debt.
And the scale was just astonishing. By the peak in 1929, the market was floating on roughly $8 billion in broker loans.
How much was that in context?
To put that into perspective, the entire national debt at the time was barely 3 times that amount. This $8 billion was capital borrowed from banks and corporations, specifically by individuals to buy stock, and the leverage ratios were extreme.
What are we talking?
You could easily buy stock with only a 10% cash down payment. You'd borrow the other 90%.
90% leverage. That is terrifying. It means you only need a 10% drop in the market to wipe out your entire initial investment.
Exactly, and that is the point where the physics kick in. When the market started to decline, even slightly, say 5%, the broker was immediately obligated to issue a margin call.
Demanding more cash.
Instantly. It required the borrower to deposit more cash to restore the collateral ratio. And if the borrower, who was likely already fully extended, couldn't produce that cash within hours, the broker had only one option.
Sell the stock. Forcibly.
Forcibly sell the borrowed stocks to cover the loan.
And this is what creates the catastrophic loop. Your involuntary selling drives the price down further, which triggers margin calls for everyone else holding similar leveraged positions.
Which forces their involuntary selling. It accelerates exponentially. The selling becomes mandatory, not emotional. It's a mathematical process of liquidation.
So the market didn't just gently correct.
It collapsed violently.
Yeah.
Because the selling pressure created by the debt obligations far, far outstripped any available buying demand. Kennedy recognized that $8 billion in broker loans wasn't just debt, it was a trigger mechanism for mass liquidation.
Okay, so let's fast forward to today, 2026.
Yeah.
The common critique is, oh, we fixed the margin debt problems of 1929.
Right.
But the source material insists that today's leverage is exponentially larger. It's just hidden. It's in more complex modern instruments. So how do we even compare that $8 billion from 1929 to the current environment?
We have to look at the scale of debt and the interconnectedness. Today, the leverage is built on 2 primary gigantic pillars. First is the derivatives market.
The so-called quadrillion-dollar bubble.
Often described as a quadrillion-dollar bubble of bets on bets.
Yes. A quadrillion is 1,000 trillion. Global GDP is roughly 100 trillion. So you're saying this market is potentially 10 times the size of the entire global economy. Can you explain the specific risk there that replicates the 1929 margin call?
Well, derivatives, like credit default swaps or complex options, are financial contracts that get their value from an underlying asset. They're used to hedge risk or, conversely, to multiply speculative bets. The danger lies in their highly leveraged nature and, critically, the counterparty risk in the over-the-counter market.
Meaning a lot of these deals are just between 2 big banks.
Exactly. Many of these contracts are negotiated directly between 2 parties, say 2 major banks, not on a central exchange. There's no central clearinghouse to guarantee the payment.
So if one of them goes down.
That's the domino. In 1929, the mechanism was simple. You couldn't pay your broker, the broker sold your stock. Today, if one massive counterparty, a globally important bank, defaults on its quadrillion-dollar stack of derivative obligations, the contagion doesn't just spread. It instantly infects every single bank and financial institution tied to that bet.
So it's the 1929 margin call mechanism, but instead of the stock market as the collateral.
It's the entire global banking system. The mandatory selling becomes mandatory systemic failure.
That feels very abstract. Let's look at the second modern leverage pillar, which is concrete and highly visible. The $35 trillion national debt. The source frames this as a margin position on a national scale. Now that sounds a little dramatic.
Does it? I think the analogy is starkly accurate when you look at the debt servicing cost.
Explain that.
Traditionally, governments borrow for investment, infrastructure, projects. Today, the U.S. government is borrowing enormous sums simply to cover the interest payments on its existing debt.
So we're borrowing just to pay interest.
If you are borrowing money just to pay the interest on your loans, you are essentially in a perpetual margin call. You need constant, fresh capital infusions, new bond sales, just to stay afloat.
So if interest rates stay high, or if global investors suddenly lose faith and just refuse to buy the constant supply of new U.S. debt, what they call a rollover failure.
That is the modern liquidity crisis. The government would face an instantaneous liquidity crunch far worse than any corporate margin call. The stability of the U.S. dollar itself relies on the perceived solvency of that balance sheet. If the market for U.S. debt evaporates, the system collapses. Not slowly, instantaneously. Because the foundation of global finance, the Treasury market, has failed.
This brings us right back to Kennedy's key realization, which is probably more relevant today than ever. When leverage unwinds, liquidity evaporates.
That's the whole game.
Either the price of a stock or even the value of a bond means absolutely nothing if there are no buyers with cash.
And the goal of phase one of the Kennedy strategy, raising cash, was based entirely on this certainty. He wanted to be the only person in the room holding cash when everyone else was holding assets they couldn't sell and loans they couldn't service.
The ultimate contrarian position.
When mandatory selling hits, whether it's from 1929 margin calls or modern derivatives contagion, the market price becomes completely irrelevant. The only asset that matters is actual, deployable, clean cash. And Kennedy made sure he was the one holding the universal solvent.
Okay, so we've laid out the why, the Shoeshine Boy signal, and the how, which is the leverage mechanism. Now let's dissect the mechanical steps Joseph Kennedy actually took. This is the blueprint for survival. The 3 phases necessary to transform this predicted national disaster into a personal fortune, and in doing so, creating a generational dynasty.
And the brilliance of this playbook is its cold clinical sequencing. It moves beyond just prediction and into disciplined execution, requiring patience across sometimes several years.
Let's start with phase 1, the hardest one emotionally, the exit. Kennedy sold everything, intentionally missing the final 10% of the rally. The sole purpose wasn't profit maximization.
It was absolute liquidity maximization.
Build the war chest.
And this is a psychological hurdle that very few people ever clear. I mean, imagine the mental agony. He had identified the top, he acted on the signal, and yet the market continued to scream higher for 47 more days.
His friends were probably laughing at him.
They were mocking him, calling him cautious, or worse. But he held firm because the goal wasn't more paper profits. The goal was to convert everything into cash, the necessary war chest.
We really have to emphasize the discipline required there. To willingly walk away from what looks like guaranteed easy money because you see the mathematical certainty of the cliff ahead.
Yeah.
It's like walking down the staircase while everyone else is stampeding up, believing the party is eternal.
That cash provides optionality. An optionality that leveraged paper wealth simply cannot provide in a crisis. And that liquidity is the non-negotiable prerequisite. Without clean, high-value, unencumbered capital, the next 2 phases, which are the true wealth generators, are impossible.
Cash is king.
Cash is the only asset that holds up perfectly under the pressure of leverage unwinding.
Okay, so that leads to phase 2, which elevates the strategy from mere prudence to active predation.
Yeah.
Kennedy didn't just sit on his cash.
No, he deployed it, offensively. By shorting the highly speculative parts of the market he knew were destined to crash the hardest.
This is the critical transition from safety to profit. Explain what shorting is in this context.
By shorting, he was essentially leveraging the inevitable panic we just discussed. He sold stocks he didn't own with the obligation to buy them back later at what he anticipated would be rock-bottom prices.
So as the mandatory selling began on Black Tuesday and in the days after, prices collapsed.
And the value of his short positions, his profitable bets against the market, skyrocketed. The source notes, he was literally making millions every hour while the country spiraled into bankruptcy.
He was harvesting wealth.
He was harvesting wealth directly from the mass psychological delusion of the new era. Every dollar lost by a panicked margin called fool was a dollar gained by Kennedy's short positions. This phase is pure financial objectivity, exploiting a known, inevitable structural failure for maximum capital gain.
This is where that idea of lonely but rich really becomes clear. The pain of the crowd is his profit mechanism.
It is. And there is a required ruthlessness to this. You are actively betting against the success and stability of the economy. But without this active hedging, you leave immense money on the table that could have fueled phase 3.
The shorting provides the capital multiplication,
The massive capital multiplication necessary for the final dynasty building step.
which is phase 3, the reentry.
The dynasty builder. This is where the strategy moves from defense and offense to long-term ownership. Kennedy did not panic buy immediately in the days after the crash. He demonstrated immense patience. He waited until the market had fully capitulated.
He waited until the blood was truly in the streets. We're not talking weeks. We're talking 1930, 1931, even 1932.
Years.
Years where unemployment was soaring, banks were failing daily, and the collective psychological consensus was that investing is dead and that capitalism itself was doomed.
And that psychological moment is vital. Assets are not priced based on fundamentals at that point. They are priced based on pure desperation and fear. Liquidation sales are happening everywhere because people need cash now to survive, not to invest for the future. And that is the moment Kennedy deployed his war chest.
And the goal was simple: trading paper. The profits from his shorts and the cash from phase 1 for tangible, real assets at distressed prices. The most famous example, of course, is his acquisition of the Merchandise Mart in Chicago.
The Merchandise Mart was the largest building in the world at the time, a foundational piece of American commercial real estate. Kennedy reportedly acquired it for a fraction of its replacement cost.
Some sources claim up to a 90% discount.
And a 90% discount because the original owners and lenders were forced to liquidate. He bought a physical, revenue-generating, debt-free asset for pennies on the dollar using his cash reserves.
This defines the fundamental wealth transfer that the Kennedy strategy creates. You sell abstract, highly valued paper assets like speculative stocks at the peak.
You hold stable liquidity cash through the crash.
And then you use that liquidity to purchase physical, durable infrastructure real estate businesses at the absolute trough of the market.
Ownership transfers from the leveraged, desperate debtor class to the liquid, patient saver class. That's the entire game.
And looking toward 2026, the opportunity will be identical. When the leveraged commercial real estate market buckles under higher interest rates, when highly indebted, insolvent businesses are forced into bankruptcy.
The person holding the war chest becomes the solution. Liquidity allows the investor to become the bank, to dictate the terms of acquisition when traditional credit markets are frozen solid. This is the foundation of multi-generational wealth.
So we've established this beautiful, brutal blueprint. However, now we face the most critical challenge: adapting this 1929 strategy to the modern fiat currency environment of 2026. The financial physics of the crash mechanism are the same.
But the chemistry of the money is fundamentally different.
And this distinction is crucial. It's where a lot of modern investors fall down if they try to blindly replicate Kennedy's exact moves.
Yes. In 1929, the US dollar was tied to gold. We were on a gold standard. When Kennedy liquidated his portfolio and held dollars, he was holding a stable store of value that could not be printed into oblivion by the government.
Right. Holding cash in 1929 literally meant holding value. If a loaf of bread cost 10 cents before the crash, it might cost 8 cents after the crash.
Yeah.
The dollar actually gained purchasing power, making his war chest incredibly effective for phase 3.
Today, the dollar is fiat currency. There's no hard link to a tangible asset. And because of the massive leverage in the system, that $35 trillion in debt, the quadrillion-dollar derivatives market, we know exactly what the central authorities' response to an inevitable crash will be.
Massive money printing.
Quantitative easing on a scale we've never seen before to prevent total systemic collapse.
Which means the purchasing power of the paper dollars Kennedy successfully stockpiled will be
What? Rapidly inflated away. Exactly. If the Fed prints $10 trillion to bail out insolvent banks and corporations, your carefully preserved war chest will lose a significant chunk of its value. It completely undermines your ability to buy real assets for pennies on the dollar in phase 3.
So the strategic necessity for the 2026 war chest must, therefore, be inflation-proof cash.
It has to be.
And the source material argues that the recommended proxy for this inflation-proof cash is gold, or had silver. So let's formally outline the adapted modern playbook for the listener, integrating this key change.
Okay, step 1. Sell speculative assets. This is the exit. You take profits from heavily hyped sectors like speculative tech and AI now. You have to accept the temporary loss of momentum.
Step 2. Convert to an inflation-proof proxy. This is the critical adaptation. Instead of holding vulnerable paper dollars, you convert your war chest into physical gold and silver. This asset retains its purchasing power when the currency is debased.
And step 3. Wait for capitulation. This is the reentry. You wait until the financial system has stabilized after the QE event and distressed asset prices have hit maximum fear. Then you trade the gold for real assets. Land, real estate, viable businesses.
This seems elegant, but we have to dive deep into the concluding debate here. Is gold truly the only safe way to execute this strategy in a world of endless fiat money printing? Or are there other viable inflation-proof assets that a well-informed investor should consider?
This is a complex debate, and it's really rooted in trust. Why gold? Well, gold is the historical default because it has zero counterparty risk.
Meaning?
It is not dependent on the solvency of any bank, corporation, or government. It cannot be printed by a central authority. Its value is defined globally and historically. So when a $35 trillion government starts debasing its own currency, gold acts as the ultimate measuring stick that preserves wealth.
But the classic objection, and it's a fair one, is that gold is a dead asset. It generates no yield, no dividends, and you have to pay to store it. If the currency debasement isn't as severe as predicted, or if the crisis lasts a decade, the investor holding gold has lost out on years of compounding interest they could have earned elsewhere. What about alternatives like Treasury inflation-protected securities? TIPS.
TIPS are certainly designed to adjust their principal value based on official inflation metrics, so they're inflation-linked fiat. But this is where the debate gets very nuanced. TIPS are still fiat government instruments. In a truly catastrophic scenario, the structural collapse that triggers Kennedy-level asset prices, TIPS carry significant counterparty risk.
Because their security and payout rely entirely on the U.S. government's ability to pay its debt.
And its willingness to honor it. If the national debt crisis becomes severe, the reliability of government instruments, even inflation-linked ones, comes into question. Kennedy was seeking absolute safety outside the system. TIPS cannot offer that.
So, if the primary threat is systemic collapse and government intervention through QE, then gold wins because it exists outside the system. But what if an investor favored, say, highly productive, debt-free, physical businesses that generate cash flow? Aren't those also inflation-proof? And unlike gold, they actually generate yield.
They absolutely are a great long-term hedge against inflation, but they fail the critical test of phase 1 and 2, liquidity during a crisis. When the market collapses due to leverage unwinding, even the best, most productive companies see their stock prices crushed and their ability to raise capital or sell products severely impaired. You cannot rely on a productive asset to serve as your clean war chest because its market value is directly tied to the functioning leverage system.
You can't liquidate a factory in the middle of a systemic liquidity crisis.
Exactly. The war chest must be immediately deployable, highly liquid, and universally recognized as value. Gold serves that function uniquely. In a truly catastrophic phase 3 scenario where you are buying assets at a 90% discount, the seller may well prefer physical gold over a wire transfer of rapidly devaluing fiat currency. Gold facilitates the transaction itself.
So the viability of gold rests entirely on the assumption that the government will choose to bail out the system through money printing rather than allowing a natural cleansing deleveraging.
And given the $35 trillion in debt and the political structure, money printing seems, well, inevitable.
The historical precedent post-1971, since we left the gold standard, confirms this bias, doesn't it?
Every single major financial crisis, from the 2008 meltdown to the 2020 pandemic response, was met with trillions in QE. And we have established that the leverage today is exponentially greater, which means the required QE intervention will have to be commensurately larger.
The strategic logic seems unassailable. If the government responds to the crash by taxing cash holders via inflation, your war chest must be shielded.
Gold is the necessary shield. It's an issue of which risk you choose to mitigate. Gold mitigates the systemic risk of central bank failure and currency debasement, but you accept the risk of zero yield. Cash, even in a high-yield account, accepts the guarantee of debasement for a small, short-term yield. Kennedy chose the former, and history proved him right.
And this strategic choice, gold as the modern currency of the war chest, is what allows the modern investor to replicate Kennedy's ability to preserve purchasing power and deploy massive liquidity for phase 3.
Without that shield, the blueprint breaks down entirely due to currency debasement.
We've reached the end of this forensic investigation into the Kennedy strategy. The blueprint is clear. The psychological signal tells you when to step off the speeding train, the mathematics of leverage tell you why the crash is coming, and the three-phase playbook tells you how to convert that impending disaster into generational wealth.
The choice for you today is stark, but it's clear. The financial train is accelerating, fueled by speculation and high leverage. You can stay aboard and toast the next new era with the crowd, or you can execute phase one, step onto the platform, and wait for the inevitable unwinding.
The key takeaway nuggets from this deep dive are simple, yet so difficult to execute. Recognize the psychological saturation when the least sophisticated investors are trading complex leveraged instruments. Understand that the crash is mechanical, driven today by derivatives and massive national debt. And remember that the wealth transfer strategy demands ruthlessness and the strategic use of an inflation-proof war chest, like gold, to enable the re-entry. You must be willing to be lonely to be rich.
Which brings us back to the inherent philosophical dilemma this strategy presents. Is it wrong to short the market, to predict and profit from the financial collapse of the economy, or is it merely smart empirical business?
It forces us to separate financial acuity from emotion, doesn't it? Kennedy saw the structural flaws, he acted to protect his capital, and then he used that protected capital to acquire assets when the country desperately needed liquidity. By stepping off the train, he avoided personal ruin. By shorting, he multiplied his power. And by buying at the bottom, he became a long-term owner of the infrastructure that defined the next century.
The market rewards objectivity, not sentiment.
So the question isn't moral, it's empirical. If you see the collapse coming, is the responsible choice to suffer alongside the majority or to position yourself to be the most liquid buyer when the dust settles?
A difficult question.
So consider your own decision today. If you internalize the Kennedy blueprint and executed phase one, selling your speculative holdings and raising cash, where would you place that inflation-proof war chest right now? Would you prioritize A, high-yield savings, accepting the risk of fiat debasement for a guaranteed yield, B, gold, the inflation-proof liquidity tool that operates outside the fiat system, or C, short-term treasuries, a slightly safer fiat instrument tied to the government's solvency? Your choice dictates your readiness for phase three. The blueprint is written, the signals are flashing. The time to choose is now.